Hello everyone. Today I'm going to help you to do the exercise 13 from chapter 10. It starts saying, Wild Horse Corporation issued 610,000 of 8% 20-year bonds on January 1st, 2017 at face value. Interest is payable annually on January 1st. So, this is a part level submission, so there are 4 parts in this exercise. The first one, it says, prepare the journal entry to record the issuance of the bonds. So, when you are issuing a bond, you are receiving cash and you are acquiring a liability, so bonds payable. Then, you are going to record that on your books with the face value of the bond. So you're going to debit cash because you're receiving this amount of cash, okay? And then you are going to credit bonds payable, also for 610,000. The second part, it says, prepare the journal entry to record the accrual of interest on December 31st, 2017. So here we are recording the interest. How are you going to calculate this interest? It's pretty simple. You take the face value of the bond that you recorded on your books times the percentage. Here you say that it says that Wild Horse acquired this bond with 8% of interest. So times 0.08 times, it's asking us to record the accrual of interest on December 31st, 2017. So it's been now 12 months from January 1st, 2017. So times 12 months of a year, right? Divided by 12. So you arrive at 48,800. This is the amount of the accrued of interest on December 31st, 2017. Now that you have this amount, you're going to open your books and record interest expense. It's an expense by the end of the year, and record the liability of interest payable. Okay, so you're going to debit interest expense and credit interest payable by this amount. Now it asks us, prepare the journal entry to record the payment of interest on January 1st, 2018. So we just recorded the liability that we have. Now we are going to pay this liability, pay this interest. So it's going to be the same amount because we're paying for the current year that just passed. So interest payable of 48,800, we are going to debit this account, and then since we're paying with cash, we're crediting cash at the same amount, 48,800 at January 1st, 2018. Then the last part of this exercise asks us to do the following. Prepare the journal entry to record the redemption of the bonds at maturity, assuming interest for the last interest period has been paid and recorded. So here we are assuming we have this bond for 20 years. And for 20 years, we have been paying all the interest. Year after year, we're paying the interest. And down, regardless of the issue price of the bonds, the book value of the bonds at maturity will equal their face value. What this means is that their face value was the first value that we got this bond, will match the maturity value or the book value. Now we are here in January 1st, 2037. So we are going to debit bonds payable, okay, by the 610,000, and then we are going to credit cash because we are finally paying this amount, 610,000. So this is how you do this exercise. I hope it was clear and it helped you to clear your mind and to do this exercise. Thank you. Have a good week.